Hello, good morning, everyone. Welcome to this week's research morning call. So before we start, just a gentle reminder that Zane is on leave today, so there will be no technical analysis. So we apologize for that. Today is going to be a relatively shorter session. We have a few stock counter updates. We have Civmec Limited, Pacific Radiance, Singtel, Google Land. For the macro, we have a software as a service sector update, as well as our usual SG weekly. So before we start, as usual, just to flash a disclaimer, so everything we share is for educational purposes only. So we're gonna start the ball rolling with software as a service. So this is actually covered by Fami, but unfortunately Fami is on leave today, so I'll be presenting on his behalf. So the reason we're actually doing this update is because some software as a service company actually released their earnings last week. So while we don't really cover these stocks, we do monitor and try to see what they're doing. So just to give you guys a brief review. Collectively, all four companies show strong revenue growth ranging from 13 to 32% year on year. So this reflects very solid demand for their services across cloud, data, and cybersecurity sectors. One notable industry trait is that they all have consistently very high gross margin, all of those above 70%. But operating margin, on the other hand, tells a different story. A company like Snowflake and CrowdStrike, for example, they actually reported negative operating margin. This is due to their very heavy investment in growth. So these companies, they're spending very aggressively on research and development, sales and marketing to expand their consumer base and enhance their platform. But overall, we see that all four companies, they're benefiting from a larger trend, which is businesses are now upgrading their technology to handle AI, cloud services, and faster data processing. So whether it's storing data, analyzing it, protecting it, or building applications around it. And they're also focusing more on the big business client, forming partnership with major cloud providers and adding AI features to their products. So this shared strategy is helping all these companies to grow and stay competitive in a fast-changing tech landscape. So we take a look at the individual company. So CrowdStrike, it's actually a cloud-based cybersecurity company to protect devices and data from threats. So they have a strong quarter. Their subscription revenue grew 20% year on year. And its cybersecurity platform is gaining popularity, especially among consumers using multiple features. So the company also saw a big increase in the demand for its expert services, like helping businesses to respond to cyber threats. And AI is also becoming more important in cybersecurity, and CrowdStrike is positioning it very well in the leader of this area. Moving on to Snowflake. Snowflake offers a cloud platform for storing and analyzing large-scale data. So they reported a 32% year-on-year increase in their revenue. It added over 500 new customers, including several large global businesses. Their existing customers are also spending more, showing strong loyalty. So Snowflake continues to introduce new tools, introducing features that help users to work with data using natural language. It also working very closely with Microsoft to expand its cloud services. So that actually helps it to reach more business clients and grow its presence. For MongoDB, it delivers a flexible cloud data service for building modern applications. So it actually saw a 24% increase in its revenue, reaching 59 million US dollar. So a big part of this growth actually came from its cloud-based database service, which grew 29% year on year. The company is also adding more than 5,000 new customers, many of which are startups working with AI. MongoDB is now focusing more on large business clients, which tend to bring in more consistent and higher value contracts. This shift is helping the company to improve its financial performance and set the stage for longer growth. And last but not least, we have Pure Storage. So Pure Storage supplies high-speed data storage solutions using flash memory. It had a strong quarter as well, helped by a major deal with Meta. Meta plans to replace most of its data storage system with Pure's fast flash-based technology. So this agreement actually boosted investors' confidence and led Pure to raise its outlook for the year. The company is also seeing increased demand for storage solutions that work well with AI application. Flash storage is faster and more efficient than older system, making it a good fit for modern workload. Other large tech companies are also showing interest, which could lead to more potential big deals in the future. So overall, the latest result from all these companies kind of highlight the strength and resilience of software as a service sector. Despite differences in their skills and profitability, all these companies are seeing solid revenue growth and maintaining high gross margin. Their continued investment in AI capabilities, cloud infrastructure, and enterprise partnership reflects a shared strategy to stay competitive. So that's all for my sharing. Now I pass my time to Miao.
Thanks, Helena. Yeah, so this is a Phillip on the ground for Civmec Limited. Yeah, we don't cover the stock, so this is non-rated. They have a market cap of 481 million, and for FY25 financials, their PATMI declined by 51% year-on-year due to lower contract volume, as the major contract has been completed. And PATMI was also disrupted by a 10% year-on-year increase in admin cost, and also a 50% year-on-year lower in their other income. And for its energy sector and resource sector, management guided that they are going into higher-end fabrication, which they do expect some recurring revenue in FY26 for both energy sector and resources sector. And for resources sector, car dumper 3 is completed, and currently they are working on 4 and 6. Yeah, so recurring revenue from like smaller contracts is expected to come from this area. And for outlook, um, they do anticipate reduced capacity in first half 26, and the utilization rate will be similar to second half 25 level, with some uptick from second half 26 onwards. And Civmec is also working on replenishing their order book by large-scale contracts and also some recurring smaller contracts, like mentioned. So FY26 revenue is expected to be on par with FY25 level, with contract award will gradually coming in from third quarter 26 onwards. They also share that US tariff does have some impact on consumer sentiment. Therefore, they are adopting a wait-and-see approach in terms of placing the new contract. And they do see some improvement in the sentiment. Yeah, so they see some like optimism among the customers. And currently, they're still focusing on improving the utilization rate for its maintenance segment. And they also expect the growth for the segment to slow down in FY26. They are currently trading at forward dividend yield of 5.3% and PE of 10 times. Yeah, that's all for me. I'll hand over to Paul for Pacific Radiance. Thank you.
Yeah, thanks. Thanks, Mel. So today it's a bit more quiet because I think half our team is on leave or just came back from leave. But so we issued a results note on Pacific Radiance last week on cruise control. Next slide. Yeah. So for those who may not know, so Pacific Radiance is similar to Marco Polo Marine in terms of the type of business that they do. So there are largely three segments to Pacific Radiance. There's a shipbuilding yard they have in Singapore, ship repair in Singapore also, and also operating of offshore support vessels. Largely three major vessels. They're operating one AHTS, one accommodation barge, and another smaller vessel, a patrol vessel. So in terms of the results, the revenue was slightly below, but I think the PATMI was a huge beat. I think they were almost double our forecast. So what happened was the positives, mainly because of the margin expansion. So the GP margin expanded almost 16 percentage points to 49%. And their admin expense or operating expenses, if you look at the table on the left, was basically flat. So most of the growth came from ship management, but that's small, but largely ship chartering. And also some of the ship repair work. So in terms of the outlook, we actually raised our earnings by 43% on higher margins and more stable operating costs because we were expecting a jump in operating costs, but it didn't happen. So they were enjoying operating leverage. We raised our target price to 9.8 cents. So we are pegging our valuations to around 8 times PE. So this is a slight discount to the industry of 10 times because they are more concentrated in their assets. So I mean, they are running largely on three key assets. So we are expecting stable earnings for them because most of the vessels, especially the accommodation barge, has already been locked in UAE. So the growth will be higher charter rates as the earnings recover. I'm sorry, as some of these ships go off charter. I think there'll be 2 vessels going off charter, so that should help the charter rates next year. And the other thing that will contribute in the second half is the sale of 2 CTVs. So CTVs are crew transfer vessels. You probably hear a lot of it at Marco Polo because these are crew transfer vessels largely deployed in Taiwan in the installation and maintenance of offshore wind vessels or wind farms. So when you install a wind farm, you need all these vessels to transfer people for either maintenance work or installation. So this is like you can call it like a taxi. I mean, like a better word. Of course, yeah. And the larger ones like the CSOV, you actually can stay in. So for this, the other thing that that will drive growth will be ship repair work. Because the global OSV fleet is aging. So when we say offshore support vessels, we are talking about AHTS, accommodation barge. So these are basically vessels that will help installation of oil rigs, subsea, and doing maintenance, support patrol vessels. You need to deliver inventory, you need to deliver supplies, you need to deliver crew. So these are largely what we call OSVs, or even you want to move the rigs and all that. I think those who've seen what happened to the industry in the probably 2005 onwards until 2016. Yeah. So these are the and the company has also net cash of 15.4 million. So in terms of the CTVs that they're building 2. I think once this 2 is sold, I expect them to build another 2. They might sell it to a joint venture to operate or just outright sell it. So the demand for CTVs, crew transfer vessels, are still healthy. There might be a lull in Taiwan next year, because some of the offshore wind farms were actually delayed. So 2027, you'll see the huge ramp up in construction activity. So demand for CTVs will grow. In the background, there's also demand for offshore wind farms being built in Korea, and then by 2030 it'll be Japan. So the next 3 to 4 years is probably going to be huge, strong or healthy demand for CTVs. Yeah. Next slide. So in terms of Singtel, last Thursday had a investor day where they bring all their overseas associates, and of course Singapore CEO, CFO will be around to do a presentation. So the key item for me when for this investor days is mobile price repair. So mobile price repair means basically mobile prices climbing back up after dropping so much due to competition around the world. Of course, in Singapore, it's still not happening, but I think most countries it is recovering. Next slide. So in terms of some of the highlights, the main thing for Singtel, the 2 key drivers is of course growth in associates, namely Bati, and the other thing is asset monetization. So so they mentioned, I think in the last results briefing, probably like 6 months ago, they actually raised their asset monetization target from 6 billion to 9 billion. And this time around, they said that the pool of assets that they can monetize is larger than 9 billion. So they've already monetized 4 billion, and the 5 billion, once they monetize, they will pay in terms of dividends. The other highlight is that they are scaling up their data centers, and Singapore capacity will double. So data centers is of course a very hot area. Their data center will double in Singapore from 60 megawatt to 120 by early next year. They also finalized the GPU as a service business model. So what has happened is that they have a partner to NVIDIA, so they will secure all the GB200, GB300 chips, and then rent it out to corporates. I think largely going to be the Singapore government, because it's going to be a sovereign AI, or all the government agencies, because I don't think government agencies here would maybe want to use other countries or so forth. So for security reasons, they're largely going to use Singtel. The company name is called REAI. That's the company that's going to do GPU as a service. The next, and then there's a need to, the other thing that the CEO emphasized was the need to adopt AI at scale. So they need to adopt AI internally. It's not just to save money, but actually it's a competitive edge, because if they do not use AI more prevalent in their operations, I think they worry that the competitive edge will be given to the customer, I mean to the competitors, in terms of lower costs and higher service levels. The countries that are experiencing mobile price repair, the key one is of course India or Bati, and then it's starting to happen in Thailand, and then Australia is still underway. Philippines is bottoming out. There was a third operator in partnership with China Telecom. That was always very quiet, but they started to compete last year, third quarter. But prices are starting to bottom up, because this we'll talk about it later. But the other thing is Indonesia is also repairing, but the economy there is weak, and that's why any price repair where they are trying to raise the effective selling price, but I think it's still very fragile. Of course, Singapore, there's hopes of that the prices can recover. It's still in a downtrend, but there's hopes that because of the acquisition of M1 by Simba, it's more like fingers crossed expectations. I think the main argument they have here is that because Simba has to borrow 1.1 billion, so they need to also kind of raise price. I mean, that's their argument. We maintain accumulate, but we actually raised our target price. I think what we did was we increased our EV/EBITDA from 7 to 8 times PE, aligning with the industry peers because we see operations in Australia improving and the earnings from data centers surging. And also we also reduced the discount from the associates from 10% to 15%. The other key thing is because they can monetize a lot, Singtel always calls this thing value realization dividend. Basically, this is special dividend, but medium term, for the medium term. So they kind of hinted that they can maintain this special dividend of 6 cents for the next 5 years, because they have more than 9 billion of assets to monetize. So in terms of some of the highlights by the CEO and CFO, I think they are going to buy back 2 billion of shares and then cancelling it. They kind of mentioned the earnings per share boost would be 1%, but they are going to continue buying back shares and cancelling. Because they have this special dividend, they are focused on growing the underlying earnings, so that when the special dividend goes away, they got enough dividends to cover. So that's the other thing. Apart from the 9 billion, some of the other assets they can sell, the pool of assets is some real estate. They got more real estate to sell. They could sell reduced stakes in subsidiaries. They don't have to hold 100%. So some of it, you're talking about NCS, some of the data centers, and maybe they could dispose some of the infrastructure assets like towers and so on. And also actually the stake in Bati alone, if they want to equalize it, is almost 12 to 13 billion. What we mean by equalize, just to get a bit more detail, is that right now they own like 28% of Bati, but their partner I think owns about 21, 22, if I'm not mistaken. So the partner in India, Bati Enterprise, and them want to have an equal stake. So I think if they want to sell more, I think that alone is worth 12 to 13 billion. So Bati is the key driver to Singtel's share price. So in terms of Bati, we call it the gift that keeps on giving, because the earnings in the first quarter jumped almost 90% year on year. And our prices continue to improve. That means the mobile price, it's not whether they improve, but I mean, from the comments from the IDEM, it's more like how much will mobile price increase, because they are virtually a two mobile operator market, them and Geo mobile, but Geo is going for IPO, so very likely Geo also wants to raise price. Advanced Info Service is I guess right now the second largest mobile operator in Thailand. And because of the consolidation from 3 operators to 2 operators in Thailand, the competition has stabilized, and they're starting to see prices start to creep up. Globe Telecom, I think, there's a bit of error in the title. Actually, I didn't change it, even the report. But anyway, for Globe Telecom, there were 2 things. So firstly, it used to be a 2 mobile operators only, but then the third one, Dito, arrived. But But that operator has a very limited very limited financial resources because China Telecom won't inject more capital unless they get more stake. But of course, this is very sensitive for a Chinese operator to take more stake. So the third competitor is kept in the financial resources. The highlight for Globe Telecom is this mobile app that they have. They call it GCash. So GCash is like the main banking app main banking app in Philippines where you transfer money, you want to buy things, lending it is the number one mobile app, probably beating all the banks. They did well because during the pandemic, everybody started to use it. So that they no plans to IPO, but that's almost 20+% of the earnings. For Telkomsel in Indonesia, the mobile price repair is big because consumer sentiment is still poor. For the prepaid plans, they are cutting the bonus airtime and they're shortening the reload period. But again, it's still fragile because consumers might shy away or competitors might react. So it's still not clear if there's mobile price repair. In terms of the subsidiaries, Digital Infraco, of course, this is after Bati, this is the star division because this is data centers. So you're going to see a big jump in earnings. They're targeting almost 300 million in EBITDA because they'll be doubling their capacity and they will also be introducing GPU as a service, a new revenue stream. Yeah. Singtel Singapore is really Star Wars kind of a new hope. That means a new hope because there's 4 operators to 3 operators, but we do not know. So that's why I call it a new hope. In terms of Optus, which is in Australia, they are also enjoying price recovery. So over there, they got, I think at least 30 or more MVNOs like Circle.com here. So it's a very competitive market, but they started to increase prices. And then they are starting to move the enterprise business. So that is also starting to improve and they are doing cost cutting. Their industry margins is mid-30s. Theirs is, I think, low 20s or mid-20s. So there's room for them to grow margins. Next slide. So in terms of this is just a slide to show so you can see that Bati is the one that has been driving most of the increase in mobile prices. When they started to have only two mobile operators or 2.5, the other one has a very weak balance sheet. You can see that the green line here, Bati. I didn't show the market cap line, but because of the Bati's market cap continue to surge up, so that's why Singtel share prices will continue to rise. The other one that's done well is Optus in red, and then hopefully Thailand is starting to climb up. Of course, Singapore in orange is starting to decline. Next slide. Next slide. So I'll move on to our macro Singapore weekly. So in terms of some of the macro data that came out last week, I think most of the data points in Singapore are actually very healthy. So for Singapore, the loans growth continued to climb. This is more than 3-year highs, loans growth of 6%. And it's quite broad-based. So you can see that loans growth is accelerating in Singapore. And it's from businesses and also from consumer. Our RevPAR, so hotel RevPAR means the room rates in Singapore, but you adjust for occupancy. So that is also starting to recover after a very weak first half. So there's also signs of recovery in hospitality in Singapore. Manufacturing activity is also healthy in Singapore, around 7%. And electronics is almost up 13%. So most of the data in Singapore is still like improving, if not accelerating. In the US, we have inflation numbers. Nothing to shout about here. I think because inflation before tariffs, no one knows when will it peak. So I need this uncertainty. Continuing claims. So employment numbers are still weak, but it is gradually weakening in a very gradual pace. I think, but excluding the pandemic, this is like the highest unemployment claim since February 2018. Next slide. So I'll move on to our tactical views. So if you look at the August performance last month, the largest gainers was in the property sector, construction, oil and gas. So stocks within our coverage that performed well was like Propnex up 74, Solview almost 70, and Pacific Radiance. So our general view is for small mid caps, because there's a dearth in growth names. I think there's a lot of small mid cap, but there's not many that's growing. And because of the huge liquidity that's coming, there's, like we highlighted last week, there's a few more rounds of liquidity coming into the market. The 3.9 billion remaining Then the 3.9, that 5 billion EQDP by MAS also need to raise money. So that's the second round injection. Of course, you're also beginning to see hedge funds start to come in and there'll be more funds that will look for returns coming in. So there'll be at least few rounds of injection. So I think what we do see is that the small mid-cap valuations are starting to move up to mid-teens and some even going to high teens or even more, um, especially those that have growth. So what we do see is that stocks that have growth in our coverage, that is like 10 times and below, these are some of the names: Solbil, Pacific, China Aviation, and Takraw. So I think if you get growth and you get valuation expansion, so that we think there's still upside in these names. In terms of some of the macro themes, we think offshore support vessel will still remain positive because there's demand from the Middle East. So although oil price is down, a lot of Middle East countries need to meet their production targets. So like even UAE, because they want to maintain their market share, they cannot lose out to Saudi Arabia. And because, as we all know, Middle East cost per barrel is still low. So even at 60s, they're still making very good margins. The other positive for offshore support vessels is that there's a new source of demand. So it's not just oil and gas that is helping the demand, but a new source, which is the offshore wind farms installation in Europe. Europe, those big CTVs, those are done mainly by Penguin International, but the smaller ones is done by like Mako, probably done or run or operated by Mako by Pacific Radiance, and their unlisted one are Strategic Marine. And the other third positive is that supply of OSVs are still very short. There's only like 6% on order. In terms of the Singtel Investor Day, all this because we write in our weekly strategy note. So just to summarize, we still like Singtel because the pool of assets. So every few months you're going to see them sell something and then the share price might just pop. So they have the assets to monetize is larger than the 9 billion they guided. They're probably going to maintain their special dividends for longer. And Bati continues to do well and generate a lot of dividends because Bati is not just growing, they are also planning to increase their dividends. So this will help in terms of the ability of Singtel to pay off more dividends and also the data center growth, plus the GPU. At the bottom is some of the key events. So we have Salesforce results, Broadcom, and also some of the payroll numbers. And our Corporate Insights webinar, which is open to everyone, is the new IPO lump chunk creations. It's on, I think should be on Friday. And then following by Yoma Comfort and so forth. Next slide. Next few slides are just an illustration. So if you look at this, so this is positive for the banking sector. Although NIMs are down, but the continued climb in loans growth, which is like a 3-year high, will help offset some of the weakness in margins. And this is RevPAR, which is like room rates in Singapore adjusted for occupancy. After the Taylor Swift impact, the decline, you notice that room rates are starting to grow back again. So they were declining since February, but now starting to grow, starting to see some positiveness. So this is positive too. I mean, if the trend continues. Next slide. Nothing much. So this is just the US market monetary condition. So even though inflation bumped up a little bit, 2.7 to 2.9, if you extrapolate, it's still quite stable and it's below the Fed's target of 3.1. So right now the core PCE inflation is about 2.9, so still below the target. Which we'll get a new update when the September meeting on the 16th, 17th happens. In terms of the interest rate cut, so the market is pricing in almost 90% probability of a rate cut. So it's a done deal. There's going to be a rate cut. Market right now expects 2025 2 rate cuts and 2026 or around 3.5 rate cuts. 3.5 cuts. Yeah. Next slide. So just a few more slides, Phillip, on the ground. So Gokoland announced released the results on Friday. So let me just share some highlights. So Gokoland is a 2 billion property developer and also investment holding company. Property investment, sorry, not investment holding. But anyway, some of the properties they own is at the bottom here, Goko Tower and in Tanjong Pagar and also Goko Midtown. So these are the two. I think one on the left is, I think, almost 3 billion. Then Midtown is worth almost 2 billion. So the other thing is that they operate in 3 countries: Singapore, China, Malaysia. The yield is probably around 4%, but this stock is cheap. I mean, it's like 0.5 times book. The earnings was flat. If you see on the left here, mainly the problem they have is China. So they continue to experience losses in China. So you notice the loss here from 22 million to 122 because they wrote off inventory. Inventory here means it's completed development properties. That means properties that cannot be sold, right? So they just write down the price and then try to sell it off. And they also have a 20 million fair value loss because of the weakness in the investment properties. They have some offices in Shanghai. Singapore enjoyed again. So you have to remove net everything, the earnings is probably up single digits. The one thing good for Gokoland is that they have rental revenue. So the rental revenue is around 300 million. But of course, they had to leverage the balance sheet. So it kind of offsets. I'm not sure what's the net income they get. They don't disclose, but it will probably help cover the almost 200 million of interest that they pay. The key assets, I think, is we mentioned. The problem is China right now because of the weak property market in Chongqing. They're selling down, I think they're marking down almost 30-40% the price. And they still have almost 600 million inventory to clear. I'm not sure how they're going to clear. Probably have to write down even more. But the one thing good for Gokoland is that they have done really well in their property projects. Most of them are fully sold. They still have 2 more. But what they've done is they developed the Lentor area. So they were the first ones to bid aggressively in Lentor, which is just above Springleaf. And they launched all these Lentor modern residence mansion. All these were actually almost fully sold out. Yeah, it was like 92, 93% or 98%. So right now they're building another cluster in Springleaf. Like we saw Springleaf residence that was 92% sold at launch. So they're actually a very unique and good developer. They managed to spot these opportunities in the north. I mean, not very north, but I mean almost yeah. But the problem is probably China will continue to be the drag on the performance with their losses. But it's cheap, I mean, it's like 0.5 times book. Next slide. Okay, the last few slides, as usual, when the month ends, we'll just give a review of what did well. So on the left is some of the sectors that done well. You notice telcos it will be because this is market cap weighted. So when Singtel does well, then of course the telcos will do well. Likewise, if Yangzheng does well, then shipping will do well. The numbers you see on the right is just some of the top gainers and losers. Top losers have got MM2, Sembcorp Industries, Franken. Gainers were Propnex, Pacific, and so forth. The one at the bottom are the index gainers and losers. Yeah, we try not to use STI, otherwise they will charge us money. But the big gainers was Yangzheng, Jardine, Singtel. Yeah, and interestingly, the REITs are starting to recover. If you look at the Mapletree and FCT, losers was some of the big, I mean, like a better word, kind of conglomerates are like Sembcorp and ST. Next slide. So in terms of asset classes, in US dollar terms, you notice Singapore actually did well in August. We were up almost we were up about 3.5%. US was up only 2% or less. And then the big performer was gold. Yeah. Again, this is just for a reference. This is in US dollar, but year to date, gold is Singapore, and the ETFs also have done well. Yeah, in terms of gains in US dollar terms. Next slide. So this is just by the country. So actually Southeast Asia rebounded. You see Vietnam, Indonesia, Malaysia rebounded. What I'm watching for is mainly the mid-cap names. I think over the past 3 months, you see the big move, almost 14.7% for mid-cap. Small cap even more, yeah. But it's not broad-based. I think it's very selected names, those that are well covered. And REITs also starting to turn positive. If you look at the 2.3%, yeah. Again, this is just for a reference. Next slide. This is our model portfolio of 10 stocks. This is not like our huge growth or our so-called gem list or small cap, but this is mainly across the board. So what did well was property and construction. the property that of course Propnex was the big gainer for our model, and also CDL and Weher. So these are big ones. Sembcorp was the big loser again. We got knocked really badly by Sembcorp. The REITs not all did well, but some did well, and among the banks, I think DBS did well. Again, this is just for reference for the year. On the right is just the performance year to date compared to the index. So the index is about 12.7. Model about 29 again, just for reference. Yeah. Next slide. Okay. Yeah. Thanks everyone. Oh, sorry. Yeah, that's it. Q&A. Yeah. Thank you everybody.
I'll take the Yang Zijiang question. Sorry, let me find. Oh, what's your view on Yang Zijiang Finance with the spin-off to Yang Zijiang Marine? Yeah, so Yang Zijiang plan to spin off the maritime investment from its Yang Zijiang Financial. So the new entity will be Yang Zijiang Maritime, which consists like investment and development in the maritime fund. And Yang Zijiang Financial will still be doing its like Euro debt investment, and also debt investment for China side. And Singapore side will be focusing on investing from Singapore to Southeast Asia in the form of private equity. Yeah, so this time will be like more in the form of a rights issue instead of like IPO, like last time when Yang Zijiang spin off financials from its shipbuilding. Yeah, so existing shareholder will be auto credit with equal numbers of shares of Yang Zijiang development share. Yeah, so essentially one share become two shares. If that's like if the share price is $1.2, it become like $60 for Yang Zijiang Financial, 60 cents for Yang Zijiang Financial, 60 cents for Yang Zijiang Maritime Investment and Development. And we expect the share price for Yang Zijiang Financial to decline after the spin off, since like majority of the business is still doing like the onshore debt development. Yeah, hope it answers your question. And what's your view on what's the TP on Yang Zijiang shipbuilding? Yeah, we don't have a target price for Yang Zijiang shipbuilding since we don't cover the stock. But for Yang Zijiang shipbuilding's outlook, we do expect second half order win to be stronger than the first half, and also margin to improve even further. Yeah, but however, from like FY26 onwards, its margin is likely to go down on the downward trajectory, since like they are taking more of the small to mid-size vessels instead of the large size vessels, yeah, which they used to take on from like FY23 onwards. Yeah, so for the smaller vessels, they tend to have lower margin. And majority and the margin appears too strong is because like it's largely backward looking, reflecting like the historical contract signing at a higher rate, and also like at a lower steel cost. And currently in China the steel cost is rising like slightly. Yeah, and they also like shut down the Renzo project in anticipation of the weaker market demand. Yeah, but in FY25, we do expect, like this financial year, we do expect order win to improve from second half onwards. Yeah, hope it answers your question. And for the Civmec presentation just now, is it optimistic or pessimistic for the stock looking forward? We do expect FY26 financials to be on par with FY25 financials. Yeah, so in terms of like contract win and financial performance will be pretty muted. However, like compared to its peers, they do have a margin, net profit margin of around 5%, which is much better than the industry average of 2 to 3%. And it's trading at a PE of 10 times, which is lower than its peers, I guess. Yeah. Yeah, and there's another one on REITs, Capital Land Escrow Trust. Why is the price range bound? Does coming F1 and year-end holiday season does not benefit it versus the like of Far East hospitality? So in 2025, FY F1 is overlapping with Chinese Golden Week. So we do expect because of the high ADR, some Chinese tourists may shy away from like going into Singapore for F1. And historically, you have two peak season. One is like Golden Week, the other one is F1. But like since this year they are overlapping together, we're probably only expecting one spec up, one hype season in October instead of like two peak season historically. So this will bring like the third quarter result probably lower than underperforming last year's performance. Yeah, I'll leave the second half to Darren. Yeah. And there's also a question for sets. The price is whipsaw, and what is holding to move up your TP? Yeah, so our first quarter result for sets is still pretty good, mainly due to the front loading activities in anticipation of tariff. Yeah, but they did share that they do see some weakness in the US cargo segment, and especially e-commerce side, as this is making up to 5% of the overall group's revenue. But they do say the loss in orders from US e-commerce to be make up by the demand in Europe. Notably, the e-commerce, the cargo demand in Europe increased by 21% year on year. And there's also resilient like domestic demand from like DHL, and also from DHL is domestic express services. Yeah, which is making up the loss in contract from due to like the cancellation of de minimis. Yeah, I'll hand over to the rest of my colleagues. Yeah, thank you.
Yeah, thanks, Pamela. Yeah, in terms of the sorry for the apologize for the target price error. Yeah, it's 9.8 cents. Yeah, sorry, there were a few people asking. Your target price is shown at 6.7, and the last was 9.8. Is this correct? Or supposed to be? Yeah, it's supposed to be the other way. Yeah, apologize. I must have blurry eyes. Sorry for that. Yeah. Yes, you're right. The target price is 9.8. Yeah, there was a typo there. Sorry. Okay. Paul, do you think the current markets, both US and SGX, including S-REITs, already priced in the likely September rate cut if it is 25 basis points? Your comments, yeah. I think I think there's still room to move. The 25 is really, I think it's priced in. I mean, it's almost a done deal. Yeah, I think the unknown is October and December. So I think the market is still a bit skeptical whether there will be a further rate cut. So September is definitely pricing if you are asking for that. Yeah. But I still think there is room to grow if you're talking about S-REITs, because at least it's my own view. It's not so much the number of cuts. Of course, the number of cuts you will never be sure, but you know the probability is higher, because especially when it's become more political now. So I think my own view at least, not to get bogged down by when the cut, exactly how many, but to know directionally the tailwind is rate cuts. Because if not, Trump's going to come in this cut it himself. So there is directionally, there's going to be more rate cuts. So yeah, and the probability is high. So my view is just play on the direction of rate cuts rather than try to pinpoint. Of course, if you can pinpoint, that'd be even better. But yeah, why is Pacific Radiance outperforming Marco Polo? I think for Marco Polo, there's just a bit of lull in the earnings. Their big CSOV, for those who do not know, Marco Polo built this huge vessel, CSOV, which is like a mini hotel, floating hotel to carry all the workers to farm the far off sites, to do installation, to do maintenance. That only came up the last few months and probably only operationally now. So you see the earnings coming up in the fourth quarter. So that's why, that's number one. So that's why the earnings are a bit subdued in the near term for Marco. And the second thing is that if you just look at the headlines, Pacific Radiance profit of 9 million was actually almost the similar to Marco Polo's 10 million. I'm talking headlines only, but of course we did our own adjustments, so it came out to almost 7 million. So the profitability was very close to Marco Polo, and of course the valuations was very cheap. I mean, if you analyze it, you're talking about 7 times PE now, or 6 plus. So I think that's why it ran up, whereas Marco Polo is trading about 10 times. But Marco is still positive. I think although we don't cover, but I think the outlook is still positive. My guess is that they're probably going to build some AHTS coming soon, because the whole AHTS market is coming up. I think they have an old abandoned AHTS somewhere in the yard, so they might use it to revive that. Yeah. Again, this was my own view, not that they told me anything. Yeah. What is the impact of the recent Australia court case against Singtel's Optus? Yeah, okay. So there is one, the data breach, or maybe I'm confusing. But okay, the breakdown. There was one case which they have already provided, I think 100 million, if I'm not mistaken. But there's one more case. Oh, sorry, there's another call there. But the other case where the cybersecurity breach, that is still outstanding. So for that, the investigations are still ongoing and they have not made any provision. So you're definitely right. There is still an overhang, but in terms of hitting the whole the share price, I'm not so worried about, because Singtel so huge group. So even although 100 million is a huge amount, so even if you do a 100 million hit, I think the share price may not react so negatively. Because in general, Optus is still performing well. The subscribers dip a little bit, but then starting to grow back again. So the whole saga or cybersecurity breach, data breach, and outage didn't really hit them operationally. But there is still one more case from the AOIO. It's in my report. Sorry, I just can't remember the exact term. There's still some investigation. Yeah. Okay. Hi, Paul. Singapore loan numbers are purely domestic or include regional loans like ASEAN. So these are purely domestic loans. Yeah. These are Sing dollar loans. You can just call it. Yeah. We don't. Yeah, we're just taking Sing dollar loans because we are taking Sing dollar loans also because we want to have a reflection of the whole Singapore economy. Because if loans grow, it's also good for the economy. So that's why we narrow it down more to Singapore dollar loans. Instead of second guessing which stock will benefit from the fund injection, like buying Toto, yeah, that's true. Although buying Toto also quite fun, yeah. Will it be a surer bet to buy SGX? Yes, you are right in that sense. I think if you're not familiar with that, or buy some ETFs, yeah, because SGX still depend on volumes. So and SGX is almost, I think, high 20 times PE. Another way to play it is just to buy the ETFs. But you're right. I mean, if you're not too familiar with the names, then you can just buy SGX. But SGX is quite expensive. I mean, yeah, or you can just buy the STI ETF, the Straits Times Index ETF. That's another way to play. What level do you think STI likely to hit by end of this? Yeah, we don't give an STI forecast because if we use STI, the FTSE STI will charge us money. Yeah, sounds ridiculous, right? But actually, because it's licensing rights. So you will notice in our report we never use the word STI, because if you use STI, so sorry, we don't actually have a target, but I think at least another 10-15% upside for us. Yeah. Please comment on Uni Asia, seems not on investors' radar screen. Yeah, so for Uni Asia, they're very dependent on the dry bulk market. The dry bulk market did recover, but I think until you see some strong recovery in dry bulk market, I don't think Uni Asia can bounce back strongly. Yeah, so that's why it's not on investors' radar screen. Yeah, not what else to add. They got the Japanese residential development, but that's a small part of the business. Unless you have a very strong view which on a dry bulk market, which is very dependent on China. So the dry bulk market, so those who do not know, sorry, a dry bulk means you transport iron ore, you transport coal, but most of it is so right now it's still very dependent on China market, although ships on order is very thin. So unless you have a very strong view, then I think that's where the unique issue. So I don't think many investors have a strong view on dry bulk because it's iron ore very deep. Excuse me, iron ore and also and sorry, iron ore, coal, and also soybean, which is another dry bulk, very dependent on China consumption. So unless China consumption rebounds, very hard to be bullish. I'm not saying that it can't rebound, but just thematically very hard to be bullish on it. What's your view on Thai baht? So Thai baht will be slow. I think with what's happening politically, although the share market has done quite better than expected, it's still going to be very slow. Yeah. You're talking about low single digit growth. So I don't think they'll be. It's cheap at I think 11-12 times PE, but for it to perform, I think investors need to at least sniff out that there's a rebound in earnings. Until then, I think it might be a bit of a just move sideways. Without any strong growth, I don't think investors want to come into Thai baht. Again, that's our view. Although we have a buy call mini because it's just cheap compared to historical. I mean, for a big consumer name, about right now, because the share price so big, probably trading about 11 times PE, and they have like a monopoly in Thailand. But in terms of price action, will be challenging until people have a stronger view on Thailand. And why do you think Keppel spiked suddenly last Friday? What are your views? We still like Keppel. We think operationally, mainly for two reasons. They still have a big monetization. They still have 14 billion assets to sell. And so we like stocks that have monetization as a story, like Singtel, because what we've seen in the last 2-3 years, that if you have a monetization, you announce that you sell something, the share price can actually react. So the market does react to companies monetizing some of the assets and then paying out dividends. So Keppel's going to do that. They have 14 billion of assets to do. And number one, then number two, we think operationally will be stronger second half. Although there's some skepticism, because even with the new power plants, some still say, because it's not contracted out, but it doesn't matter. As a new power plant, they will be more efficient than everyone. They just sell and there'll be earnings coming in. So there's a new power plant. There's the whole new tower, office tower, Keppel Towers. I always forget the right name, but there's a new tower that is coming up, which is now 50% occupied, and the submarine cable. So we think you get the combo of assets monetization and earnings growth. Yeah. Singtel, does the chart show any pullback ahead? Okay, yeah. So sorry, today Zain is on leave. Half the team is on leave. So that's why we don't have any technical. Sembcorp, yeah, for us, we still like Sembcorp. I think the share price got hit badly because I think we mentioned before, for two reasons. It was below expectations. They kind of disappointed the market. They didn't, in a way, guide the market well. We thought that their power business will be strong in this quarter because last year they had some one-offs, but there were also some one-offs in last year. So but we think we still like it. So we're not too concerned about it, because power demand in Singapore is still growing. And then number two, they are going to IPO their renewables in India. At least we think so. I mean, that's their plan. And number three, they are going to jump dividends. So I know the share price has been very weak, but we still like the stock. Yeah. how do you view? Yeah, I don't have a there was a geo call just now at 11. It just ended, so I didn't listen to it. But I didn't like the deal. I don't have the details yet. We didn't like the deal because they are buying tugs and barges at, I think, 2 to 3 times price to book. And these are tugs and barges. It's not the highest. This is not like the most sophisticated vessel. And this is a related party transaction. So, from the, from the op, from we don't like the optics of it. But I need to get details from them because they only wanted to do a call in 11. But we will meet them separately and we'll try to share. But on the surface, it's not a good deal. I think. Yeah, you're paying this at I think 10 times price to book or 8 times price to book, if I'm not mistaken. Yeah. Can you please show the last Singtel slide? Yeah, can someone pull that slide? Yeah. Yeah, whoever's in charge of the slide deck. Can you put the Singtel chart slide on? Who's in charge? Helena, can you put the Singtel slide? Okay, this one's for Mel. Excellent summary on Singtel. Yeah, thanks. LHN to spin off co-living business. Is it good for shareholders or share price? Yeah, okay, this one's a bit tricky. Okay, so yeah, this one I'm a bit wary because it may be good for shareholders, but I'm not sure about the impact on the share price because if LHN is being listed at Collywood, then we worry investors might just go to Collywood instead. And of course, LHN might still have a stake in because it could be a all new share issue. So LHN shareholders may not get any tangible benefit. You get a mark-to-market benefit. I don't know. That means you got this nice or big gain on paper, but you don't see the actual tangible benefit. It's like nice to see a building, but you don't get any rent from it. So it's the next slide. Helena, is the next slide. The one with the chart. Yeah. Yeah. Okay. Yeah. This slide. Yeah. Okay. But will it be good for shareholders or share price? Yeah. We're just my worry is that if Collywood goes, then why would investors buy LHN? They would rather just buy the Collywood because that's where all the growth is. Yeah. Of course, you trade at a premium. Yeah. So for this chart, is just okay. The question was, can you please show the last Singtel slide, the one with revenue streams from Singtel, a major associate? Yeah. This is not a revenue stream. So this is the mobile ARPU. So this is the indexing of the mobile prices. So if you assume all the mobile prices in December 20 was the index of 100, so you can say that Bati's mobile prices jumped 70% through this period. So it's not revenue. I cannot put all the prices because some in rupees, some in Sing dollar, then the chart will be all over the place. So that's why we have to do a bit of indexing here. Yeah. I hope that helps. Yeah. What's your view on Hotong? Yeah, sorry, we don't really know this company. Yeah. Do you expect a traditional September correction on US and US stocks? Yeah, we don't believe in all this seasonality because because every month there's a news flow. So I think after the September FOMC meeting, it will be what the Fed says. So on Friday, it will be very important. The payroll numbers. I think in the table we mentioned expectations about 63,000. So any weak number from payrolls, I think you can price in at least 2 to 3 cuts from coming from the Fed. So I mean, like a better word, it's very data dependent. So it depends what is Powell guiding in his commentary after the September meeting, whether will he guide for more rate cuts. But again, directionally, it's just going to be more rate cuts. So very hard to pinpoint the exact ones. Because again, there'll be a new Federal Reserve chairman in May. So even then, the market will closer to that date. I think the market definitely going to price in. And if Trump were to remove, the lady, then I think all the Fed appointees on the FOMC will be more than the Biden appointees. So it becomes very political. So you can be assured there'll be more rate cuts coming because it becomes a very political decision. So this is going to be a tailwind for the market, but I mean, the pinpoint, I'm not very sure. Yeah, sorry for that. Yeah. What's the worst case scenario for Guoco Land due to its China unsold inventories? Will go belly up? We don't think so because they are actually clearing the inventory to get cash flows. So so even if you do another 100, 200 million right now, I think Gokko Land can take it because they are making about sorry, I can't remember the numbers, but they are making about 100, 200 million. So they can take all these write-offs, but I think they will do it progressively. Yeah, no, but go belly up, no, yeah, because they have about no, they have such a yeah, I think the net debt is about 4 billion. Yeah, we don't think so because they are naturally collecting a lot of cash, especially once they sell out all these properties, because they never disclose, but they have a huge unsold revenue to be recognized. So once that's sold, they will get a lot of revenue and cash flow for them. So belly up is no, yeah. Okay. Darren and Mel, you want to take on some first? Yeah.
Yeah, thanks, Paul. Yeah, to follow on what Mel mentioned on the earlier question regarding FEHT and class, yeah, she already mentioned the part on FEHT. I'll just talk a bit about class. So for class, basically, yeah, all this is kind of expected that seasonally the second half will be stronger as well, even in Singapore as well as for classes overseas properties. But for class specifically this year, it's really quite firmed up and like almost guaranteed that the DPU will be um can't remember off the top of my head, but I think 6.1 cents, because they already mentioned that they will use some of the previous divestment gains to top up if there's any shortfall. Yeah, so it's like 6.1 cents. That's about the 7% yield. So that is almost guaranteed. So yeah, the downside for that is quite low also. Yeah, on top of the fact that the second half seasonally should be stronger. And they did mention that they are planning to lock in some event-driven demand as well globally. So there are a lot of global events like concerts going on and such since the opening like few years ago, 2 years ago. Yeah, so all these are starting to benefit. Uh,
Yep. Okay.
there's another one. Most are up except for NTT-DC. Yeah, so NTT-DC, I spoke many times about it. Why we think that the REIT is not doing too great as compared to some of the other competitors. Yeah, so for instance, like the payout ratio is they're paying 100% for the first year, and management fee also. I mean, yeah, so they didn't retain any capex, capital, capex reserve. Yeah, unlike Capital DC, for instance, where they pay only 92%. So that's how they managed to get a 7% dividend as of the IPO price. So that's one of the reasons. Then management fee, they're also paying 100% unit. So all these are few a few reasons why NTT-DC over the longer term the yield will likely come down. So as a result, the market, I guess, kind of priced in that as well. So the share price has been sold down. Yeah, CLI, we believe the first half slightly weak because of the lack of transactions. We think we'll pick up second half onwards, especially since first half because of Trump and his uncertainty and his policies. Yeah, there was a lot of wait and see. So investors basically they're taking a lot of the wait and see approach. So um they are showing interest, but they didn't finalize anything and no deals were made. So in the first half, I mean, very few deals were made. So yeah, second half we expect that to slowly pick up. Yeah, and as a result, more event-driven fees, more divestment gains, more event-driven fees for the fund management business as well. So we're expecting a stronger second half. Yeah, so likely the share price will start to recover then. Uh, the is Weir likely to do a REITs here? I don't think so. Not that I've heard of yet. Yeah, yeah, but the Centurion REIT is soon, very, very soon. Yeah, that's all I can say. Yeah. Yeah, what's the outlook for MLT GoKoLand? Yeah, so GoKoLand, Paul talked about it a lot already, so I'll just talk MLT. MLT, the China portfolio is definitely the drag for them, but we expect it to improve, especially since a lot of the rents have already been marked to market over the past two years, where we've seen negative reversions like double digit for the past 2 years. So we think is almost bottoming soon. Like probably a few more quarters of low single digit negative reversion before it starts to rebound. So the MLT that portfolio likely to slowly improve. ESR REIT their portfolio reconstitution, call it, has already taken shape, and they've had some divestment gains, and their DPU year on year is also up by 10%. So the outlook is like kind of on a road to recovery as well. Yeah. Yeah, I think that's all for me. Yeah, thanks, Paul. Oh wait, sorry, that's all. What high REIT street gave set 100%? Yeah, that is NTTDC REIT. Yep. Yep. Thanks. I'll hand it back to you, Paul. Thanks.
Yeah, okay. Yeah, thanks. So, the next question, what is the second half outlook for AEM? Yeah, Yigba is not around, but I think their guidance was flat. So I need to double check, but I think their guidance was flat. So I think the problem the market has with of course, apart from changing CEO so many times, the other issue is that they continue to say they have new customers, but even with new customers, we don't see much growth in them. So, yeah. And the new customers that they're going to secure is largely hinged on, I think, AMD and the HBM customer. So it's still very AI driven, and I think what do you call it? The market's view on AI has also dampened a bit. If you ask me if I'm going to buy this stock, I might just buy Nvidia because if it's so dependent on AI and new customers, so I think the market is very a bit disappointed on the guidance, and also despite numerous times saying they got new customer, but you don't really see the numbers coming in. So I think that's the issue. Yeah, I think to buy EM, yeah, my own view is, well, you really have to take a big leap of faith. I mean, go through so many hurdles just to get exposure to a semiconductor stock, where there's so many semiconductor stocks out there. Yeah, so I don't see any special reason to go and take a position in this particular company. I mean, that's my own view. Yeah. What's your outlook on Secure? I guess it's Secura. Yeah. I'm assuming, because the question is, what's your outlook on Secure growth, positive, negative, whole? I don't have we haven't seen him for many years, so I have to skip this question. Yeah, sorry. Any sharing regarding EQDP for small mid cap? Yeah, we've been sharing quite some time, but let me just give you an update right now. So of the 5 billion, of course, 1.1 billion has been given. We think the 1.1 billion has only been dished out or given to the fund managers only the last 1 to 2 weeks. Yeah, and some may not even been ready, from what I understand. So the money hasn't really been coming into the market. My guess is very slowly right now. And not all of the 5 billion will go into small mid cap. That's a reminder, although we do the numbers, but because it depends on every fund manager's mandate. So I think the MES wants variety. So some will be pure small cap. I think even REITs could be bought. It depends on the mandate. Although they won't disclose the mandate, but I think the preferred, a higher chance you will get the money if you focus on small mid cap. But it's just that it doesn't mean they cannot buy index, but only some will buy. Yeah. So probably a small portion of it will go to index stocks. Hi Paul, mentioned that hedge funds are coming in as such as STI move up. Is it a good time into STI related ETFs? Yeah, I think we are still positive on the market. Yeah, for STI. I think like we mentioned before, the last week, or maybe it was another presentation, but the 2 or 3 reasons to like Singapore, of course, is a safe haven return status. And then economically, things are still healthy. I think, like we mentioned earlier. Number 3, there's a lot of liquidity coming back in, and the valuations for Singapore market is about historical levels. I think like 13, 14 times. So it's not like excessive. So the Singapore market is still, for us, is still positive. And if interest rates were to continue to decline, Singapore probably the unique place, because we got a lot of ETFs. Yeah. But on the index, it's probably only like 10%. SGX target price, I think I leave that to Glenn for target price. Now, Paul, what you have, iFast, I'll leave it to Glenn. Okay, the rest is all, Meow, I'll leave it to the, okay, what do you think about Comfort Delgo's earnings and upcoming performance? Okay, and a rate cut. So a rate cut will be positive for them because they started to take on a lot of gearing. Again, for Comfort, we're talking about a high single digit, low teens kind of growth. And there will be growth for them because I think the London repricing will be at least 2 to 3 years. But what can really move the share price from the current levels if they need to show the strength in earnings from some of the new things that they did. They won the Manchester bus route and they spent I think 100 million on buses. So we need to see that. And there are a few so that's number two. And number three, there's a few railway contracts being bidded out. So if they secured that, then I think the market will view it positively. I'm talking some of them some of them are in Stockholm. One of the big ones are in Stockholm, if I can recall correctly. Yeah. Okay. Of the three, UMS, Franken, and AM, which is the best? Okay, for us, we like Franken the most. We like it because the valuations are in the low teens, I think 12, 13 times PE. So that's why we like it. And they have a very strong customer. They're very entrenched in ASML, and ASML is a monopoly. So we like it. We do know, of course, the market now because of what's happening in the US and because of the kind of almost profit warning by Applied Materials. I think the market has responded negatively. The whole semicon has been down, but among this, we like it. UMS might actually surprise too because they mentioned, although I got kicked out from the call, they mentioned that the main customer in Penang, which is Lam Research, is increasing the loading. I mean, the volume is coming up, and they might get an additional order, an additional program from Applied Materials, which is their major customer now. So I think they could also, but for us, we cover we cover Franken, and we like that the most. Yeah. Okay, I'll let the rest take on first. Yeah.
Hey, thanks, Paul. Yeah, so I'll take the SGX one. Our target price is currently $16.90. The catalyst for growth, I think, Paul did mention a bit earlier, SGX is currently quite expensive now. I think it's around high 26, looking around 26 PE. I think the main catalyst for SGX would really be the volumes. So you're looking at volumes to continue to grow strongly, really from the heightened volatility. As long as Trump is still the president, right, and he does whatever he's going to do, then volatility will be high, and then that's how you get volumes. And also, the input by the MAS also will help to boost volumes for the small and mid cap. But then I think there's one thing that we are a bit cautious on, which it wasn't really I would say highlighted a lot during their briefings, which was the treasury income. So if you look at SGX's net profit, right, is actually down slightly. It's mainly due to this treasury income, which is a bit like how a bank works, where they put their deposits or excess deposits. But in terms of SGX's case, it will be the collateral balances. They have quite a huge sum. It's around 100 over billion. Yeah, I think about 100 billion. Yeah, so it will be put into deposits and fixed deposits, and that's how they earn that interest. So they make around 11 billion. Sorry, so they will make quite a substantial amount of this. It's around 57 million in second half. So it has been continuing to decline, as interest rates continue to drop. I think so that's the one factor that we are a bit cautious on, and we have seen it continuously drop. And that's what's really affecting a bit of their net profit as well. When it was asked, what is the outlook for the treasury income, they didn't really say anything, right? They say it's really depending on the rate cuts, and market conditions. And the only positive, I think, is that Japan, which they also have funds in, right? In the end, it's the only place that doesn't have the rates are not going down. So that's really the only positive. Yeah. So just to be a bit cautious on the treasury income side. But volumes have continued to grow. We are continuing to see very good momentum in volume growth in even all the way up to July and August, where volumes have continuing to grow by double digit. So that's the main catalyst for the growth for SGX. Yeah, for iFAST, the question is, what are your views on iFAST in the competitive banking landscape? What are its competitive edge, please? Yeah. So we don't cover iFAST, but some views on iFAST. The main thing is that iFAST is for the banking side. I think you're asking about the bank, right? The UK global bank. It's really trying to be a global bank, right? It's competing. It doesn't really have a main competitor in that sense because a lot of the banks are quite localized, or they concentrate in where, in the area that they are in, right? So like for example, you look at the UK digital bank, it's really concentrating on the UK deposits, right? In maybe in Europe as well, just extending a little bit, but they don't stretch all the way until Asia or ASEAN. Same for Singapore as well. You look at the digital banks here, they're all really concentrating in their own region. Whereas for iFAST, the main difference, the main competitive edge is that they are global, right? So that's what they've been trying to say for the longest time, where they want to be like the Netflix of banks. You can get a Netflix subscription, or you can get this banking subscription or bank account anywhere in the world, and it's the same for someone who's living on the opposite side of the world as compared to someone living in Singapore. So that's the main competitive edge. But of course, that also brings up the question that what will happen if, let's say, the digital banks, the large players, or even the domestic banks in UK or in any other country see that, whatever they're doing is working, then they might just adopt that same practice because, there's nothing stopping them from doing it. But I think the main difference is that the larger banks are not as agile or as small as iFAST is, so they will have it'll take them a lot longer to adapt, to try to reach to a global audience instead of just local. Yeah, so that's the main I think competitive edge for the iFAST, the banking sector, the banking side, sorry. Yeah, yes. So someone asked, the massive sell-off by iFAST second largest shareholder, does it mean that iFAST is already overvalued or at least at fair value now? I'm not so sure, why the reason why they did sell off, right? It might be because they're just trying to take some profit because the share price, has gone up quite a bit. And I think the after the sell-off, it might have gone down slightly. So really hard to say, whether it's why did they sell off? Yeah, so a bit hard to answer that question. Again, we don't really cover iFAST as well. It's just some of my views after listening to their briefings and talking to some of the management as well. Yeah, okay, I'll hand it over to, I think, Darren. Yeah, thanks. And Mel, thanks.
Yeah, as you wait for Darren,
Oh.
yeah, Darren, you go ahead. Yeah.
Oh yeah, sorry for the delay. Yeah, there's one on Manulife. So please update on Manulife. Yes, yeah. So for Manulife, if you're not aware, the occupancy has fallen now. It's about 60+%. So the market is still quite challenging, and for them, the issue is that they must still start cut down their gearing because it's still above 50% as well. So they need to slowly lower the gearing, and it is likely that they will have to divest at least another building as well to fund this. Yeah, so that is the update. So they're still definitely not out of the woods yet. So far in my view, I think Manulife the worst performer, or rather the operating conditions are the most challenging compared to the other two peers that are listed on SGX, like the Core and Prime, because the other two, they are in some better markets where we're already seeing some recovery in the office occupancy, leasing demand and such. Yeah, and Manulife also, they had some quite bad negative reversions, 10% down. But they did mention even though it's 10% down, it's still above market rate. So that just shows how much the market rents have fallen in the markets that they are operating in. Yeah, for Centurion, we spin off any benefits for Centurion, yeah. So this question is more suited for Iqban. But I believe that they will pay out some dividend in species, if I remember correctly, for this Centurion spin-off. So there is some benefit. They will return some money to shareholders. Yeah. What's the latest situation with EC worry? Yeah, sorry, I don't really follow, but I think they're still in default. So yeah, I don't really have any comments for that. So apologies. For Prime, what's your target price? Yeah, target price 21 cents. They're trading about 0.3 times price to book. So yeah, it's still heavily discounted, but we do see signs of recovery where they're not buying rents. Basically, they are seeing positive rent reversions, improvement in rent, improvement in portfolio occupancy as well. Capex requirements still remain high, but that is just to draw in tenants and secure like longer leases, like 10 years. So that is there is some visibility there when they do that. So probably within the next year, we will see more, or I mean not probability, we definitely will see those leases that were signed previously will start to contribute cash because the rent-free periods will start to be over, and that will start contributing to the distributable income. And it is possible that Prime will be able to at least increase the dividend payout starting next year. So now they're paying like 10% of their payout ratio, which translates to about 2% dividend yield. Yeah, so in our forecast, we're expecting 50% next year. That's about 8% dividend yield. I think that might be all for me. Yeah. Yeah, that's all for me. Yeah, thanks. Hand over to Paul. Thanks.
There's a, if you look at the S-REITs as a basket, what percentage upside for 2026? Yeah.
Well, let me find it. Oh, the first question. Okay, I didn't see that. So if you look at S-REITs as a percentage, as a basket, what percentage upside? Yeah, so it's really hard to call for a share price upside, but we do see signs of recovery. Like operating performance remains fairly resilient among all the different subsectors. I mean, there is some slight weakness still in the US, like I mentioned. And China also a big weakness there as well. But other than that, the operating performance still seems quite good, coupled with the fact that interest rates are on a downward trajectory. Like first half really saw so many REITs really saw interest savings year on year, and as a result, DPU improvements. So we expect that to continue as rates continue to get cut. Yeah, but to us, as a basket, what is like the index, or what is the potential upside? That is hard to say, but based on our target price, on average, roughly based on like the 12 stocks that we cover, we have a buy recommendation for most, which means the upside is more than 20%. So yeah, that is our view for 2026. Roughly on average, yeah, 20% ish possible recovery from here. Yeah. Yeah, hand over to you, Paul. Thanks.
Yeah, I think I think we need to realize what is helping the market and also REITs is also I think Singapore interest rates, if the MAS was the Federal Reserve, Singapore probably did like 6 rate cuts in the last 12 months. So interest rates in Singapore, the 3-month SORA, I think dropped like 3.6 to 1.8. So Singapore has aggressively cut rates. So we cut faster than the ECB. We cut more than everyone in all the central banks. If we were actually a central bank, yeah, because we did like 6 rate cuts. So I think more than everyone. Where can I get the recording? So the recording, we put it in our PhillipCapital YouTube channel. We usually try to upload it as soon as possible. Is there a webinar? Yep. There won't be a webinar because Zane is on leave today. Yeah. What's your view on Thomson Medical? The price went up recently and the dip today. I'm a bit more cautious on Thomson Medical. I think there's a lot of hype because they have a hospital plan. I think it was already indicated they will do something with the land, so I think people just got so excited. Because operationally they are still in the loss making. So just to give you an update, there's a briefing later, but just to give you what has happened is that in Malaysia, because they lost two insurance companies, so I think they are they need to recover, get the insurance company back, and then the third one obviously will ask for a big price discount. So they are recovering from that. Then for Vietnam, it's a very competitive market. There's a lot of aggressive marketing, and that's hurting the business. Singapore is starting to recover, although we all know birth rate in Singapore is not doing well. But Thomson, they are moving out from just doing childcare, I mean deliveries, yeah, and moving into more even um cancer and other cancer, and also just in my mind, but actually, they're moving to oncology and so forth. So I think Singapore is on the right track. Just that the other two markets are a bit challenged, so we're not sure. We need to get an update to see whether is there any recovery. Uh, but for the Johor land, what they done is just announce a plan. So you still need to see them selling some of the land, because half the land is going to be for a hospital and the other half the land just for property development. They can sell it raw. So we're not sure what's the exact plan right now. So you just need to wait for that. So, but I think it's a bit overrun, yeah, in the very near term. Just because you have a plan, doesn't mean that you can get the valuations that you want. Yeah. Can you repeat what is VRD? Okay, so for Singtel, what they done is, of course, they pay a ordinary dividend, and they have this special dividend. They call it value realization dividend. I don't ask me why. Yeah, yeah, because if you call this dividend special dividend, then people have the mind that this is very short term. So they take it as VRD so that people know that this will be around for the next few years. So this will be based off the monetization that they do. So assuming they monetize 9 billion, some of it will be the VRD, which if you hit 6 cents, about 1 billion a year, and then some will be for growth. Yeah, some will be for share buyback. So they try to separate the monetization into a separate pool, which will be used for dividends. Some of it will be reinvested. Okay, Propnex already run up. Okay to pick up APAC Realty as an alternative. Yeah, so for me, we still like the leaders. Yeah, so you can imagine if Apex don't run, then I mean if Propnex don't run, then I don't think Apex can run too. So even though there's a big run up, if you look at our own valuations, it's about 15 times. At 240, Propnex about 15 times PE FY25. We've always been very conservative because we use DCF, and we know the huge volatility in their earnings because of the property market and cooling measures. So that's why our valuations were always very conservative. I guess it should have been, I mean, on hindsight, it should have been more aggressive. Can you give your thoughts on Propnex? Who is on the barrel continue this trend and make a detour downward? So for me, we think the momentum can still continue because what you have to watch out for is the upcoming sales, because now is Hungry Ghost Festival, so you could probably see probably in October there'll be new launches again. So you need to track if the new launch is, I mean, this is the obvious thing, but how I will track it is how is the performance of the new launches. If that is going to be strong again, then you're looking good for 2026 earnings. So 2025 earnings is confirmed, it's a done deal. So it's about 2026 earnings. And because of the huge number of GLS that's been done, so 2026 could be another strong year. I mean, we do not know because we still need to see the launches and all that. Right now it shows it's not about demand, it's about supply. So with the 10,000 GLS done, and possible launch of that. So the pipeline for 2026 is still healthy. Again, we're not expecting a stellar growth in 2026. Even a low single digit is considered very good because we are forecasting about 90 over million profit, a record high for them in 2025. Then behind the scenes is, of course, Propnex grabbing share. So that is something that APAC may not have because Propnex is getting more and more real estate agents. I think you can do the numbers. They are outgrowing APAC Realty in terms of the number of agents. Whether can get share, I really don't know. Because when it comes to really well sold properties like Springleaf Residence, even though you got a lot of agents, it's about luck because it's a draw. Can imagine that you buy a 2.5 million property, it's a lucky draw if you can get to buy it. But that is what is happening right now. So, but again, we still think Propnex will outperform because we still expect Propnex to gain market share. So of course, if you hold the stock, my view is, although our target price is lower, but to keep it, because I think if the next launch in October does well, then I think this share price might rally again. And if you're a EQDP fund manager, the 5 billion EQDP, you probably want to buy these brand names. These are easy to understand business because most of these fund managers are not very familiar with Singapore. So they probably buy the Sheng EQDP, QNM. Those are consumer brands, and that might give them a bit more valuation premium because easy to understand. Franken keep dropping, so half my holdings at a loss. Hope to see. Yeah, So we still like Franken. I think semiconductor is a very volatile sector. It's like 5 minute hot, 5 minute cold. But we still like it. Because they are still a major customer, because they got this huge major customer ASML, which is a monopoly. So any update on micromechanics? I don't have it because I couldn't attend. I was in so many meetings, but I think Yik Ban attended. But the outlook for micromechanics is strong. Mainly, okay, so micromechanics has two parts, which is the back end, which is if you do a wafer, they do the rubber tip to pick all these wafers. But that's very volume driven. I think we mentioned last week. But the other thing that has done well is they are starting a new segment, which is a front end. So they're doing something similar to Franken, which they never done before, or maybe to a certain extent UMS. This is something front end which is new, and they're doing out of US, which is even more unique because I think they did mention that they are seeing more customers approaching them because they are one of the very few that have a semiconductor equipment parts. I think they're doing some parts in the disposition chamber, which is the most highest precision. So I think that that makes them quite unique in a sense. But I don't have a gauge of the earnings growth. I think I have to ask Yigban for that, or Ben. But they are definitely they will do good because I think they're starting to get more customers on the front end. Just that I don't have any sense of the trajectory, so I don't have. But directionally, looking strong. Okay, what's your view on First Resources going forward, and also Palm Oil? What's your outlook for Wilmar stock price? So we prefer First Resources over Wilmar. I think we highlighted that a few weeks ago because of First Resources. Of course, you're benefiting, plantation company. You're benefiting from, of course, the high oil price. Number two, they are benefiting from the acquisition that they made. They bought another listed Indonesian palm oil, which they think they can raise the efficiency and so forth. And number three, they just ramp up their biodiesel capacity. Just slip my mind the amount, but so they are And palm oil. So palm oil in the globally, palm oil all dependent on only one thing, which is Indonesia's B40. So if Indonesia go to B50, then I think palm oil will surge. So it's just a matter of time. So palm oil, the reason palm oil had done well is mainly because of Indonesia's biodiesel. But I think in the near term, the recent events that's happening in Indonesia might kind of play down the sentiment a little bit. But I think medium term is still positive because I think Indonesia still wants to go into the B50. That means blending diesel with palm oil. That has been the big support. So and that's why palm oil price very hard to come down because right now it's not being used for cooking, it's being used for driving. So yeah. ST Engineering and this stronger support seems every day down. Yeah, I think the valuation has the big re-rating, which we were worried because I'm not sure what's the level, the technicals, but we don't think there will be we think any stability will only happen when the next results comes out. Yeah, the next third quarter update. Yeah. Singapore Painkill. Sorry, I don't really cover that. Franken went lower again. Is it good to accumulate some? Yeah, some shares for long-term investors. Yeah, I mean, for what it's worth, some insiders are buying, but I wouldn't say it's really a lot of shares that they're buying. But we still like it. I mean, if you still believe in the whole semiconductor, so they are benefiting not, of course, not only because semiconductor demand is still getting strong, because AI demand is still strong. Nvidia sales is still up 50%. But secondly, there's more and more outsourcing coming to Asia. I mean, even though Trump may come out, but I think the ASML is shifting some of their supply chain into Asia. And then number two, the Franken is doing the highest end product for ASML, which is yet to ramp up. Yeah. And you're trading at 13 times PE, which I'm not sure among all the probably one of the cheapest semiconductor stocks out there. And they're doing the very latest kind of cutting edge semiconductor. So we still like it. I mean, but of course, sentiment for all semiconductors are down. Can you advise on Intel government taking a 10% stake? They can dictate sales away from TSMC. I'm not so sure because when Intel fight with TSMC, it's not about who is their shareholder, it's who has the best technology. So I don't think Donald Trump come in will help Intel make their chips better. So I'm not sure he knows much about semiconductor, but I don't think it's going to make any. It might actually worsen it because if the government, then if I'm a sovereign country, I'm not sure whether I want to buy chips on Intel. So the 10% stake is it's not going to make them technology more progressive. Maybe if it's a property company, maybe it'll help. So yeah, so Intel is still playing catch up with TSMC. So I don't think the 10% stake going to make any difference. Yeah. What's your view on US 20 versus 7-10-year Treasury bond outlook in view of the potential Fed rate cut? Yeah. Okay, I'm not so good on the bond, so I think I'm going to skip this. But yeah, so sorry because you're talking about whether the yield curve will steepen or what. Yeah, that one I don't have. Maybe next time our credit analyst, which just joined us, can help you on that. So I apologize. Some things I really do not know how to answer. Yeah. City development, I leave it to Darren. And I read. Please comment on the SG cut rates ahead of Fed. Do you think that this Fed rate cut will lower the SORA? It might a little bit. I think SORA now moves more on the Singapore exchange rate rather than the on the liquidity coming, because the liquidity coming to Singapore just spiked up. So if you have a very bearish view on the US dollar, because structurally, then short-term movement, I'm not so sure, but we think we might drop a little bit. I don't think it'll be a lot because the Singapore already dropped. It's like 6 rate cuts already for Singapore, so I'm not sure it can go much lower. Yeah, because the yield differential or the carry between US dollar is actually quite huge. Yeah, so I don't think it might drop. My own view again, is this like 99% guessing kind of work. May I know when is Propnex next earnings and target price? Yeah, the next okay. So the problem is Propnex only announced every 6 months. My target price was low. My target price at the time when they were trading at 160, my target price was 202, I think. Yeah, so it's far exceeds. But I can understand the momentum. Even right now it's 15 times, and if there is more news coming up, the property launch, I think this one can climb further. I mean, that's my own view. Yeah. What's your view on Credit Bureau Asia? Credit Bureau, okay. I mean, Credit Bureau is like a better word, it's almost a rent-seeking business. So Credit Bureau Asia, for those who do not know, whenever you apply loans, you have to get a Credit Bureau check. It's compulsory. Because you may borrow from UOB, but the UOB doesn't know how much loans you have with DBS or OCBC, so it's compulsory. Of course, the banks let you check each other because they're all shareholders of Credit Bureau Asia. But the problem is there's the lack of growth. And it's trading at 30 times. It's definitely a very good company, but it's trading at I think almost 30 times PE now. And it's just a lack of growth because the legislation seems to not allow, or I wouldn't say not allow, they still get difficulty in getting more customers for the data. So I don't think money lenders, if I'm not mistaken, money lenders or digital bank can, but money lenders may not get access. So stockbrokers cannot get access to the data. So there's still a lot of companies that cannot get access to the complete data. Credit Bureau Asia, and they are still the country that they're growing is in Cambodia, but that is that takes time to grow. They went to Myanmar, but of course we know what happened to Myanmar. So yeah, so it's just the growth potential, but it's a really good company. But just that the growth and the valuations at 30 times might maybe kept the upside in the near term. That's my view. Oh, the view on Vihe. Okay, so for Vihe, there was a question on the REITs. If you don't have a REIT with 1 billion of assets, I think you can forget it. I think you'll be subscale, nobody buy you, then your dividend yield go to 10%, then how you going to buy any assets? So if you don't have a big enough of REITs, you better not come and list. Then instead it makes it harder for you to acquire, and it's like negative. So we still like Vihe because we think there are a few drivers to the share price. Number one, construction order book might grow because they are still bidding for some HDB projects. Number two, they still have a few assets to monetize. They still have 2 sets of student dorms in Australia to monetize, which is I think another 20% or 30% stake in the first fund that they sold to GIC, and GIC sold to another Australian fund. And they have another fund which holds 1 student dorm, Australian student. So they still have a few assets to monetize. And then they are developing, they have a new business. So this one is a bit touch and go. They are developing a new land business. That means they're going to accumulate land and develop it. And it's very tough to accumulate this land. So this is a new business. And the third thing is that the new student dorm, which is 10,000 bedder, the first phase came up, I think April or June. Again, it slipped my mind the exact month. But about 2,000 beds, but the remaining beds will come out in December. So by end of this year, they're going to have like 25,000 beds. The unknown is the Tuas dorm that they have, which is 15,000. So our view is that the authorities will renew them for another 3 years or so. Because if the authorities do not renew, then there'll be like 15,000 foreign workers looking for a dorm, which I don't think they're going to find it anywhere. Yeah, anywhere, especially with so much construction activity coming into Singapore. So these are the few categories: the construction, the assets that they can sell, the dorm that they have, and the rising room rates. And of course, if Centurion gets IPO'd, it might kind of put some positive sentiment on Vihe. And the fourth is the new land business. Now I do not know whether it will work or not, but that's the new business. And Vihe's track record, they're very good in spotting opportunities. Like the student dorm, they went in quite early. The workers dorm and also student dorm, they were kind of one of the earliest ones. Okay, I think I answered 500 questions. Okay, I'll leave it to you, Darren, first. Yeah.
Yeah, thanks for the update on CityDev. What are positive and negative elements going forward without the influence of Phillip? Yeah, so for CityDev, for us the outlook still very bright, especially for the property development segment. Investment properties segment remains relatively stable, except for China. China, a little bit of weakness there where the occupancy is around 50-ish%. If they could possibly monetize any of these Chinese assets would be good, but that is really challenging, lack of buyers. And going forward for them, definitely they will also attempt to ramp up the pace of divestment. So first half already they divested 1.5 billion. So we can expect some good dividend payments or special dividends for CityDev in the full year results. Negatives, possibly I would say a more flattish hospitality performance from the hotels. Operationally wise, because of a strong FY24, probably just improved by low single digits in my opinion. Yeah, so the improvement will not be that much. What without the influence of Phillip, I think I don't think there'll be much difference. To be honest, that's just my view. Prime outlook on Prime Capital Core. I spoke about it just now. IREIT Global, the upside will come probably 2027, 2028 after they start redeveloping the Berlin campus. Other than that, they still have to backfill some vacancies. So over the next one or 2 years, there will still be some not so great performance over the next 2 years until possibly if they can successfully redevelop Berlin campus into um, like the hospitality, and I think that's their plan. Yeah, then yeah, likely then things might improve for them. Yeah. Uh, Potential REIT IPO from JD.com. Oh, I didn't see that news. I'm not heard of it, so I'm not aware. Yeah. Yeah, can't really answer that. Yeah, I think that's possibly all. For your answer, the
Yeah.
remaining there's
Oh,
still a
okay.
bit. Yeah,
Yeah,
thanks.
thanks. Yeah, thanks for the questions. What's your thoughts on Asian Pay TV? Yeah, I apologize. I haven't gone to any of the briefings for a few years, so I'm not really not very updated on what's going on. Any thoughts on Alibaba? I think the share price really did like a 19% jump, right? I think because the earnings was strong, but if you strip out that, I think the earnings was down 18 because there was some investment gains. The market seems to be very positive on their cloud, but again, I'm just reading it off the news, so my value add here is like 0 or my negative. So sorry, I'm not sure if Helena has any much can contribute, can anything to say, but for my side, nothing much. Any update on LHN? I think it's about the results should be coming out soon. And also it will be the Collywood IPO. Yeah. So we're not sure. It could come out with, but it apparently Collywood IPO is apparently very well. The reception is very strong, I think, from fund managers. Yeah. But whether can it drag up LHN's share price? I'm not so sure. I do not know. Because I do not know if people might sell LHN and instead go buy Collywood. But apparently the IPO has been very good response. Yeah. What's the potential for HRNet? Okay, so for HRNet, so for those who don't know, HRNet is actually the largest, I think, recruitment agency in Asia, definitely in ASEAN, but in the near term, I think the earnings should be stable. Talking about maybe low single-digit growth. Because Taipei is doing well for them. I think Taiwan, they're getting a lot of recruitment jobs. I'm talking about executive permanent recruitment jobs from Taiwan, mini semiconductor and technology. But the medium term, it's about a bit of transitioning for them. So they have two businesses. For those who may not know, they got permanent recruitment, those headhunters and so forth. And of course, they are big. They are in 18 cities. And also the other part is flexible, which is the temp workers and so forth. So the flexible hiring, I think that to me always has been a multi-year story because they need to roll out this model in many countries, Indonesia, Malaysia, because their strength is the balance sheet, 300 million, and also the technology and the processing. It's just that they don't like the margins, the competition is tough, so that's why they're rolling out slowly. But that is a structural growth. The permanent recruitment that is headhunting, I think that needs to do a bit of a strategic reset. So not reset, the strategic change. So they are focusing more on CEO roles. Because I think the middle income management roles, those are already taken up by LinkedIn. There's a lot of technology taking up some of the slack there, share there. So we still like it, I think, but just that the growth need to be stronger before we get a real strong push in the share price. So you're talking about maybe a mid single digit kind of growth. But it's a really, I mean, they're operating 18 cities. Yeah, so it's one of those rare recruitment agencies which is such a large scale. It's an industry that's easy to go in, but very hard to scale up. Yeah, so anyone can start up a headhunting company, but can you scale up like them? I think it's, I wouldn't say impossible, but it's very hard to do it. Any target price on Alibaba? Yeah, sorry, Zain is not in. Since you mentioned recovery on hospitality sector, which counters will you put in the forefront? I think hospitality, our coverage is Frasers, right, Mel? Frasers Hospitality REIT and Escort. But if you want a pure play, it would be Frasers Hospitality, OUE to a certain extent because they have Hilton. Any input on okay that one? When and where is Hollywood? I think it should be soon. I don't have an exact date. It should be the next 1 month or so. My guess is the market cap could be 300 million and more. My guess. Okay. Let me run. There were some questions on the chat. Sorry for those who put on the chat because we normally try to answer at the Q&A. Are the pending rate cuts by the Fed likely to move gold prices up or down? It should. I mean, one way to think of gold is like a zero coupon bond. It's like a bond that don't pay interest, but will pay you the capital. So if interest rates come down, then it would definitely be a positive for gold. Yeah. Gold and chip. How can we continue? Chip group or Baba Outlook Lichen. Lichen, sorry, we don't cover. Maybe got to ask Iqbal. Yeah, thanks for that. I leave the rest to Darren and Meow, then we can edit. Yeah, thanks, Darren.
Am I going to answer that Hong Zhi question first?
Hi, I'll take the Yang Zijiang financial one. Can you share on Yang Zijiang financial with their expansion and what can investor benefit from Yang Zijiang Group, its overall future? Yeah, so they're expanding on maritime investment, which is leveraging on Yang Zijiang shipbuilding's expertise, so they can benefit from like cheaper material cost and also like cheaper cheaper like shipbuilding cost. So Yang Zijiang can charge a spread. And some business also involving like providing loan to shipbuilders and also ship owners, and also contacting local banks and all yeah to issue them loans. As a group, like they are able to benefit from the spin off since they can unlock in value. As currently like their price to book value is still dragging down by the debt investment in China. So after they spin off that part, the value of the maritime investment fund can be unlocked. Yeah, that's why like their share price performance has been pretty good. Like after they announced the spin-off plan. Yeah, so now it's trading at pretty much 1x PB. Yeah, hope it answers your question. I'll hand over to Darren. Thank you.
Yeah, thanks, Mel. Yeah, just last two questions on entity DC REIT. Any input on there's new on entity DC REIT? Should it be positive? Yeah, so no new input for now. Any thoughts? Share price seem to tank, accumulate or cut loss for these those allocated IPO price. Yeah, it's really hard to call, but in my view, I think like I mentioned so many times before, the reasons why there are some headwinds for entity DC REIT. Yeah, but the market basically they're pricing in the fact of those headwinds, like the fact that the dividend yield was only in the first year will be that high because of the fact that the management fees will be put in units and the zero capex reserve. So over time, definitely as they start to allocate some um capex reserve, and as management fee they perhaps shift it a bit towards the cash terms, as if they keep paying the dividends in units, then over time dilution will be more and more. So probably likely over the next few years, over the next initial years, once it stabilizes, likely they'll start paying a bit of cash management fees. So until then, likely the absolute dividend will keep decreasing. So as a result, the market is just pricing that in my view. So yeah, so another reason I think that the hype around it was so high because of the fact that GIC is the one of the cornerstone investors. Yeah, other than that, yeah, yeah, basically that's just my view.
You want to explain maybe when they pay in units, you kind of boost up the dividend yield. Maybe some may not understand.
Or
Just in-
yeah, so basically when you pay in units, because you pay in units, then over time, like the amount that they have to issue, that basically if you pay in units, they have to issue new units, right? So in the following year, they have a higher unit base. So when they have the higher unit base, then definitely the existing shareholders will be diluted, and with the same distributable income, they divide by more the enlarged unit base. So as a result, the dividend per share will be lower. So if that keeps happening over the next couple of years, so over time it will just keeps diluting and diluting. So that is a negative.
But it's a near-term boost, right?
Yeah, but definitely that would be a near-term boost as from the 7.5% headline dividend yield that they mentioned. Yeah, that was the reason also that they managed to get that, because of this fact that they are not paying cash dividends. Because basically, if you pay cash dividends, your distributable income will be lower from the cash that you pay out. So you can distribute low. Wait, sorry, what am I saying? Basically, if you pay cash from the pay management fees in cash, or DI will be lower. Yeah, correct. So when our DI is lower, you can pay. Wait, I'm confusing myself.
I think distributable income is like cash. So like what
Yeah.
Darren mentioned, yeah. So if you pay in units, so instead of paying the manager 10 million in units, you instead of paying the asset manager 10 million cash management fee, you pay in units, then that 10 million now can pay to shareholders. Which we all know it's a bit warped lah. I mean, it's a bit of a one eye closed winking kind of dividends. And so I think that's what Darren's trying to say.
Yeah. That's exactly right. So they are paying the cash in management fees to the manager instead of paying using the cash to pay dividends. So yeah, that is why over time, if they continue to pay more units, more management fees in units instead of cash, then basically they'll have more uh cash to pay out in the near term, because of the fact that they are not paying cash to the manager. Yeah, as a lot of other REITs where they pay probably about 50%. So 50% cash they pay to the manager, so they can pay that 50% to shareholders instead. Yeah, 50% of cash instead of yeah. I think that's what yeah, I hope that's all entity. Got a lot of questions on that. I hope that clarifies. So trying to keep cash by paying dividend. Yeah, so that they're not say trying to keep cash, just that if they pay the management fees in units, then they'll have that spare cash portion that they can pay out. So which is why that they managed to get the higher dividend yield in the first year, because they're paying all the fees in units. So they had that, like Paul mentioned, that 10 less that figure, just a number to for explanation purposes, at 10 million, instead of paying the cash to the manager, they issue new units to the manager instead of that 10 million cash. So as a result, that 10 million cash they can use to pay dividends. So that is why that's how they managed to get a 7.5% initial yield based on IPO price, because they're paying 100% of the management fees in units for NDTD series. Yeah, hope that is clear. What's the meaning of some of the parts? That just means let's say a conglomerate company, then you use let's say let's just use Takraw for example. Takraw, there are so many business parts, right? So we add the lifestyle business together with, let's say, the Germ Life Holdings and the investment property business. So we just summing up all the different business units that they have to come up with a valuation. So that just means some of the parts. Yeah. Banyan Tree benefit from hospitality sector recovery. Yeah, if there's recovery, definitely there are units they can benefit. Not sure whether Paul has anything to add, but I don't really follow them, so I don't really have any comments.
Yeah, so for Banyan Tree, yeah, they should benefit, but Banyan Tree, you must understand, they also do property development in Phuket and the one that I always monitor for Banyan Tree is the ability to get management contracts. Which if you remember in the past, they were working with Accor in China to get management contracts. And I think that was the positive for me. Because they didn't really do much of a briefing, so they managed to build up their management contracts. So property development, as you can property developers maybe trade one-time PE, maybe I give you since your land bank so limited. But I think they managed to grow a lot of the management contracts in China. So that was a surprise for me. So that was, I think, structurally a positive story. But I don't have the numbers of me because we tried to meet them, but we couldn't. Yeah. But hospitality, yes, I mean in general, yeah. But they are not only in Singapore. I think Singapore is quite small for them, yeah, compared to Thailand and China. Yeah. Thanks. With that, yeah, thanks. Thanks everyone. Thanks for your time and thanks for your questions. Yeah. Apologies today. There's no technical because Zane's on leave. He'll be back next week, so you can accumulate all the questions and give it to him next week. Okay. With that, thanks everyone for your time. Hope it was useful and hope to see you again next week. Yeah. Thank you, everybody. Take care. Bye.